Hi, good evening, and welcome once again to the QuickBooks seminar, webinar. We're in our company, we do it all, and indeed we have learned how to provide services, a broad range of services. We also have set up a company to sell merchandise, different types of merchandise. We have created charts of accounts. We have customized our chart of accounts with MRTLS in 3 different locations. As I showed you, we have it in the income section, you have it in the merchandise, for the merchandise, you have it in the inventory asset. You also have it in the cost of goods. Now, let's say we were a company that has 20 different inventory asset accounts, and we keep track of many types of items, or we have many types of services, not so much the items, but we have different revenue streams that come in. So our chart of accounts, the key word is the chart of accounts, which is basically the category of expenses that we have. And there are companies that have dozens of lines. It's not just a couple that are set up. It's true that QuickBooks asks you when you set up the file, we made an LLC, a general service business. QuickBooks may and gives you a general summary of accounts. That's how we set up our chart of accounts. And we only made, in our case, several modifications. So we have here our chart of accounts. And what do we have here? We have, let's leave the balance sheet accounts on the side for a second. If you go down, we have, one income account. We have cost of goods, one item. We have advertising promotion, we have automobile expense, we have bank. And it's a pretty short list, maybe 10 different items: interest expense, meals, and entertainment, office supplies. We don't have yet payroll over here. There are many types of categories of expenses. So in our P&L, the only type of expenses that will show up will be limited to these types of expenses that are already created in the chart of accounts. So we could have an advertising expense from Ami Magazine if you would drill down to that. It means if you go to our P&L and you'll see the advertising expense for $250, you'll double click, you'll see where your advertising expense came from, which that would show up from the vendors. You'll be able to see why you have that expense. The automobile expense is a car expense. You have bank service charge and computer. There's nothing else in letter C besides the computer and internet. So even though we don't have yet the computer and internet expense, we have a computer asset, right? And the same thing is with we do have homeowners association expense. We created that. If we wanted to start a new clean company, that means all the transactions we have here, we want it to be zero, no balances in the account, no profit and losses. So we don't have any transactions entered, but we want to have the chart of accounts that we customized and we spent a lot of work on. How would we do that without manually deleting every single transaction? So the answer is we have the file menu drop down, which is new company from existing company file, which means if you go into it, you will be able to create a brand new company. In this case, you could give it a different name to the file. You don't have to call it We Do It All. You call a different company. I think what we did last time, we Do It All too, just to differentiate and compare. And you'll be able to replicate all the charts of accounts in this file. And it'll be a clean file with 0 transactions. I spoke to you last time about the audit trail. So obviously, if there's no transactions in the QuickBooks file, there won't be an audit trail, but then you won't have the transactions either. So it's not like you could just clean up the file by making a new file and getting rid of the audit trail. You won't have any transactions in this file. Then we have Open Restore Company. So we have one company which is called We Do It All, and usually you might keep it open in your computer, and it's there. Sometimes you exit the program, and then it brings you a when you go into the program, after you close it, it'll bring you up a screen asking you different types of company files you can open. There's open a company file, restore a company backup, restore a portable file, and convert an accountant's copy transfer file. What are all these things about? This is something which it's not day to day that you will be dealing with accountant's copy, at least not at the beginning, but it's important to know what different types of files there are in QuickBooks, the technical know-how. And at some point, we might do some review of this review class, but there's a lot of details, so we're going to try to sprinkle in every class different facts that you should be aware of. It's also on the certification test, which you'll hear about in the future. So the way it works is, when you say you have a program called Microsoft Word, so the extension of the file is always the same thing. DOC used to be, now DOCX it's called. You might have an RTF extension, which is rich text format, but that's not really the format that Microsoft Word works in. That's just RTF is a type of format of transferring text through different applications. They do it through RTF format, or you can also have it with .txt, which is text format, but you'll be losing a lot of your layout. The RTF would keep the rich text format, you would have the layout. What we have in PDFs, that's portable document file system, whatever that is. So that is not really text that you could type into. That's like a file, which you move from computer to computer. You can watch it you could see it on handheld devices and tablets. So that's why it's called portable. It's easy to move around, but you can open up and start using it as a word processing document. But PDFs are, let's say, in Adobe or in other viewers. In Microsoft Excel, you have also one extension, XLS or XLSX. QuickBooks has many different extensions based on the type of file that they have. So we're going to go through a couple of them. Yeah, you might have also in Excel CSV files, which is beyond the scope of the QuickBooks course. So we're going to learn about 3 or 4 extensions today. You see it right here in front of you: QBW, QBA, QBB, QBM, QBX. So a regular company file is called QBW. You might use as a reference QuickBooks working file. And when we open up the source location on the computer where we store it, you want to open up a company file. Company files are QBWs. But there's also called accountant's copy working file, and hence the QBA, the A for accountant. So sometimes you have in an office, they're working on a file and they send it over to an accountant to make some complex journal entries, and the accountant will do it and he'll just send, and they're still using it at the company. They're still working on the file. And what they'll do is they'll just bring back some of those journal entries that the accountant makes. If you recall, I mentioned that we have under the company, we have making journal entries. We also have under accountant, make journal entries. And that's in this accountant version software. So when the accountant makes a journal entry, assuming he has an accountant's copy, it will be an alert. There'll be some type of dividing date where the company cannot make changes going backwards, only going forwards. So let's say we'll be at the end of December 31. And in January, the company is going to give an accountant's copy to the accountant. So the company can still work on January, February as they go along, but they won't make modifications prior to January until the accountant who reviews the file will send back those journal entries to import. And otherwise, it wouldn't make sense if the accountant is basing his information on the copy that he has in the company, and then the information all of a sudden changed on the company's end. So they'd make the dividing date. That would be the accountant's copy file. Then you have a backup copy. QuickBooks always creates, so the QBA is only when you're sending a file to an accountant, you will create a QBA file for the accountant. But what you do have is, besides the QBW, which is the working file, you also have a QBB, which is the B for backup, right? QuickBooks backup. In case the computer crashes and the file gets corrupted and something doesn't work in your file, you don't lose all your information. Sometimes you can use a PC, the PC doctor utility that QuickBooks has to try to repair the file, but at least as of the previous date you use the file, you'll have a backup copy. So the backup copy is always updated when you close your QuickBooks file. It'll recreate the backup. You might have multiple versions of backup. You could do that as well. And then you restore. That's what they're asking you. Do you want to restore a backup copy? And you turn that backup copy, the QBB, into a QBW. Then there was called a portable file. Yes, and they're telling you that this could be from a backup file, it could be from an online backup. You have a portable file, which is, I guess, the M extension for mobile, where you shrink the file and you don't have all the information, and it's a portable way of transferring it, and then you have to recreate. So in the case of QBW, since that is the working file, all QuickBooks has to do is open it up. You can open up the working file, you can open the accountant's file. But the backup files and the mobile files, they themselves are not in the proper format, and they're not the same data size as a regular working file. But QuickBooks can and has the capability to restore these backup files and portable files into a working file. Sometimes the process is successful, sometimes it gets stuck in the middle and you have to recreate it, as the case of many times you have with software. Then you have what's called an accountant's copy transfer file, right? Not an accountant's copy working file, a copy accountant's transfer file, and that is X for the transfer. And sometimes that is the method that they do. They don't make a QBA and send to the accountant. They might transfer to the accountant with a QBX, and the accountant will take that QBX and convert it to accounting copy's working file. Okay, so either you're going to convert an accountant's transfer file, which is a QBX, to a working file. And that's the two steps you're going to do. You're going to select the QBX and you're going to turn it into a QBA. So that is for the open and restore functions in the file drop-down menu. Now, if you look here, if you had multiple files and you have a quick shortcut, if you would go open restore company file and you would go next, it would start searching your computer. What's the location that you had, right? I said I want to open a new file, so it's closing out my current file, right? I could press, I'm not saving anything. So you X out, you say open a different file. It's going to ask you in your section what type of file you want to open up. And I could say, no, forget about it. This is recent files. I was just in my queue, redo it all. I'm going to go back into my redo it all. And what accountant's file has, that the functionality is to have two files open at the same time, a very useful feature, especially if you have two screens. So you can have two files open, one on one screen and one on the other screen. And one is called this is called the second. Now it's a secondary because originally it was a primary. I have two files open, and you'll see here, and this is part of the exercise. You see, this is a secondary file. There are some restrictions or that you have in a secondary file over a primary file, and even a primary file itself has a couple restrictions that it cannot do because it's a secondary file open. So, for example, I believe you can't send emails out of a secondary file. I might be mistaken, but I think that's one of the things you can. Okay, actually, you could. You cannot import banking information into a secondary file, only in the primary. And QuickBooks will let you know about that when you open up the file. or it'll give you an alert that you can't do this because you're in a secondary file. If you want to run payroll, also it's in a primary file for sure, maybe even in only a single file open. I like to do payroll after Hanukkah because it's a topic which I don't want to start it and take a big break and come back to it. And also because we have to get through some technical support, people downloading a file with QuickBooks payroll enabled. It's an add-on feature. And instead of walking everyone through it, I'll just you'll be able to download an activated file. So as we're going down here, we have we can open previous company. I'll give you a whole list of previous companies you open, so you won't have to look where in your computer you have it stored. And then we have backup company. You could create a local backup or restore previous local backups. So in the backup company, it doesn't only tell you how to create a backup, it also shows you how to restore a previous local backup, which is the same idea as you go to open and restore a company, because an open restore company, it also gave you the option to restore backups, right? So what's the difference from open, but again, in QuickBooks, they give you different options. Then we have here different utilities that you could do. For example, someone asked me earlier in the course, you have import Excel files. You could bring in information from an Excel file. If you have a customer list, there's a way to create a customer list without entering one by one, the name and setting up the address and the phone numbers. You could take Excel files and break it up by, we're not gonna do that right now, but we could take over different columns in Excel, and that will be a column in QuickBooks. And in that way, we'll be able to import information. You also have IIF files. Those are, and we have general journal entries. So general journal entries, we discussed before, you could just import, right? It's utilities, import. And you see how multi-layered QuickBooks is. You have one drop down that goes to another one, that goes to the third one. You can import a general journal entry that's a GJE file, in short. You have you can bring timer activities. Web Connect files is the preference of choice of banking information. And that is an extension called QBO, QuickBooks. And the online is, I guess, if it's coming from the web, it could be online files. And just like you could bring it here from the utilities section, we'll see later on that even for the banking drop-down menu, you can also import Web Connect files. So we went to one previous company. So going through the utilities, so we have IIF files. IIF would be if you're not importing from an Excel Direct file, right? Because Excel files have an XLS extension. I believe the IIF files are files that you saved in Excel ready to be transferred in. You cannot import data in a secondary QuickBooks file. This is an example. Exit the primary QuickBooks file. Again, this example, certain things you can't do in a secondary file. But what we're going to do, I'm going to close out the other file that I have open. And let's see. Over here. Okay, it should have closed that out. Let's see. Yeah, but it's okay. Closed out, and now we have. We do it all now. It doesn't show the word secondary over here because we close out the primary file, and you have utilities, and if you would import IIF files, it'll tell you QuickBooks has to close all the windows to open IIF file, which is fine. Then as we start looking, you can have lists, transactions. This is very technical know-how. I don't believe that they ask you about the IIFs in the the exam itself, but this is another thing to know about. It's looking for an extension on the right bottom corner, IAF, because we told it we're looking for IAF. And going back to the drop down of the utilities, same way we could import files, we could also export. Now, exporting, you could export your list to IIF files. Same way you could import IIF, you could export. Same way you could import timer activities, you could export timer lists, and export payroll to XML is very, I'm not familiar with that right now. Synchronized context, you could convert from Quicken or Peachtree, you could import data. So if you have a file that wasn't Quicken, you could bring in information. You can move QuickBooks on a computer. And you could send, and this is what we said before, you could send a accountant's file, right? You could open it and transfer, convert a transfer file, or you could convert the accountant's copy to a company file, or you create the portable company file. Again, the portable company file is a QBM. The accountant's transfer file, a transfer file is QBX, and the accountant's working file is a QBA. Okay, so we're going to stop on this section over here, and we'll leave the printing forms and the send forms for next topic when we have an invoice we have to email. So then we'll show you how to do that, because that's what you do. You go to send forms, and you could email invoices. Let's take another moment to look at the edit sec. Okay, edit also depends on which window you're in. Right now, we don't have anything. So if I go to edit, I can use a register. What register? If everything's closed, it'll tell me I can use my bank register. Technically, every single balance sheet account has a register. And that makes sense, right? You have the assets, that's the bank. You have accounts receivables, an asset. You have the liabilities, which is accounts payable. You have credit cards, the payroll liabilities, which we didn't create it yet, but it's there. We have the mortgage, and we have the equity accounts, the draw and the opening balance and moving equity. Those have registers because it keeps track of it all the time. And someone asked me, that's why we have in the Control A, which is the chart of accounts, we have actually a balance that shows up. There's a balance that shows where on the permanent accounts, because that stays fixed, it doesn't disappear. The lower accounts, which are the profit and loss accounts or the income statement accounts, those change variably based on the time period, right? Depending on which time period you want, that will be the expense. You can have expense of the day, of the week, of the month. So there is no real balance until you make a report out of it. You make a report, you get to how much was my expenses for this period. But the bank, on any given day, has a fixed balance. It might be negative 77, like some people still have. It might be plus 368 if you make the deposits, etc. So if I am highlighted on an individual account like Chase, then if I go edit and use register, automatically it's going to go into the Chase account register, right? And I see my history in my bank. If I would go to my accounts receivable and I was highlighted, and I go to use register in the drop down, automatically it'll bring me a history of my accounts receivables, what it was, how it started, those amount charged, amount paid, and then right, we received payments, and this is our leftover balance. So this is the registered mode, right? This is the same balance we recall for the balance sheet. We could get the report and the reports balance sheet, and we'll see here the 1567.25. This is the report way to see the summary. If you double click on the report, you would see a breakdown, right? That we billed a total of 2,900, we received a total of 1,400, and the balance. So we have the report version, which is the balance sheet. We have the drill down, which is when you double click, it's called transactions by account. And then we have the window, which is the register mode, and that's the account receivable, where we're seeing here the breakdown in a register option. And just to remind you, what is it when you make account receivable of 10, 12, 50, what really happened? Right? There's a sale. So we know that the account receivable is a debit because it's an asset. We're going to collect this 10, 12. What's the credit? The sales. But let's refresh ourselves a second. When we're talking about Chaim Yankel on his bill of 225, that sale is services. It's a clean debit and credit. It's one debit of 225 to account receivables and one credit 225 to sales. Let's make a control Y, and you'll see, right? You have here the sales price is 75 because that's per hour, but we have 75 debit, 225 debit, right? It's account receivables, and service is 225. So we said that our sales for services we call service, and for web design. And the same thing will be when he pays $200, the last payment, it doesn't make a difference if it's the 400 or 200, it's still the same Rabbi Cohen. Then we're going to credit the account receivable and debit undeposited funds, right? We credited the account receivables because we're doing the reverse. Now that we're collecting, we have to undo the debit and credit the account receivables. And where does the money go? It didn't go to the bank. It goes to undeposited funds. That's what QuickBooks puts it before we go to the bank. When we will make a deposit, that will be the next step. Then we're going to credit undeposited funds and debit the bank. And that's how things move back and forth. But by the 1012, if you recall, it's a combination of services with TLS and MR. And let's see this interesting thing because we never really did this. We have cost of goods. Remember, we have with the debit inventory. Look how complex. It's not a 2-line entry anymore. Now you already have a 5-line entry because obviously it's one big debit for account receivables. But we also have a debit cost of goods, right? TLS, right? This is our cost of goods that we're going to recognize on, 25 pieces of times 2 is $50. And now we have a bunch of credits. We have, first of all, we have, we see over here, we have $700 was one type of service that was for GC. You see the item listed over here. I could stretch open the back so you can see what's going on here. We have $700 for general consulting. We have $100 for housekeeping. We have $50. And that's why you might want to, this is really crediting our inventory, right? We said it has to match. That when we have our orders, it stays in inventory. The inventory is the asset. We have to have a matching debit and credit. So we credit inventory because we're taking away the asset. We're crediting inventory TLS of $50. We're debiting inventory TLS, cost of goods TLS, $50. And 212.50 is the actually sales income. That's extra. That's what we're making. And if you think about it, we're selling it for $850, and it cost us $2. So we're making $6.50 per $6.50, and we're selling 25 of them. Let's see here. So our profit is $162, but the sales is $50 more as well. We account for the whole sales. It's a sales income of $212, but we're debiting against it a cost. So the net profit will be $162. Let's see and as you see, the debits and the credits are matching, right? It doesn't have to be one for one. It could be a general account receivables and one cost of goods in the debit, and then it gives you a total on the bottom. And the right side on the credits, it's giving us the breakdown of the multiple credits that we're doing. We're crediting sales, $212. We're crediting inventory for $50, and we have $800 in different service revenue. Let's close out this register, and we're closing out. Okay, and edit now. You could, since we're in the report, it's giving us the option we can memorize our balance sheet report, which is this fiscal year to date, which is 12/2. It wouldn't have changed yet, even if I had this fiscal year to last month. If I go to drop down this fiscal year to last month by the dates, it will change it to 11/30, but it's really the same because it's including the class on Monday, which is 11/30. There was no material change. Now, just to remind you, we're getting a little excited about all the profits that we made this year, or the sales for that, in the P&L this fiscal year to last month. We made $31.65 in income, but this is all on our accrual basis, which includes the $1,567 for account receivables. If I would click on the cash, I would drop down to barely $1,600, right? Under $1,600. All of a sudden it's $1,598 because we're dropping out. We're deducting the $1,567 from the income. And the same way, that would be the difference on our expense side. Right now we're showing the total expense of $7,497 because we're not counting the unpaid expenses of $250 or the vendor merchandise, for example. But if I would go to the accrual, I would jump up from $7,497 all the way to $8,201. So this is again reminding you what happens between a cash and accrual basis. So you can memorize your reports in the edit mode. You can use the register. What register? So since we're not highlighting anything, it's going to ask me which register because you're in the report, as opposed to in chart of accounts where you're landing on a particular person. And by the way, the same way you will have general chart of accounts for account receivable, right, which would be the customers, right? We had before we opened up the account receivables, which shows us our 1567. If I was in a customer center on a particular customer, like Gabai, for example, then if I do edit and use register, it's going to give me a register just of this customer. This is similar to what we discussed. See, we have Gabai, he had a 112, 1012, and 339. It's limited to customer Gabai. And since we're in the customer section, we'll have only the customer registers. We got Rabbi Cohen's register, how he paid us $400 before he even, this was actually the same day. First, we have the invoice of 600, we collected 400, and we collected 200. This would be similar to the subsidiary ledgers that we discussed in the first class. Here you see each person individually, what their balance is, 140 or 1352. You could see, if you go into the register of that customer, you'll see their individual ledger. Or you have what we call, as if it was the general ledger. On the balance sheet, it gives you the sum total of accounts receivables, 1567. QuickBooks pulls it all together for you. But note, if you would double click on 1567 over here, you will not see the breakdown per customer. It just gives you account history of what your receivables were and what your open balances are. So you could see over here, you would see on the bottom, you would see Yankel still has 150 and Cohen has 400, etc. But he received a payment 400, 200. You would have to figure out from there Mrs. Cook still owes us 140. It doesn't tell you clearly over here that Mrs. Cook still open at 140. So if you look on the top, you have your invoice of 600 from Rabbi Cohen. You have two payments, Rabbi Cohen, 400 and 200. It cancels out. Rabbi Cohen has a zero balance, but you don't see that in this report. But if you would go back to the customer center and watch Rabbi Cohen, which is zero, you could go into his register, use register, and you would see, without going to his register, you'll see on the side over here the balances. And when people getting lost in the first class, they went in the transaction tab and they look at the invoices to see the total amount and the open balances. So over here on the invoices, you could see the total billed amount of $2,900. And again, this is for this fiscal year. It will go up by $70. If I go from 2987 to 3057, because we're going to add, let's see here, Oh, actually not in the invoices, because again, this is only the sales for invoices, not the sales receipts. Sales receipts is a separate column, which has another $178. Another place I showed last time to see open balances is going to reports, customers and receivables, and the customer balance summary. Customer receivable, again, reports, drop down customer receivables, customer balance summary. You can see over here the 1567 and just a short. You don't have to see all the zeros. See, when we went before in the customer section, you would see sale under invoices, you'll see every customer and including all the people that are zeroed out. But now we only have several open balances as of today, and that you could see in the customer balance summary, 140, 1352 total, and 75. And that is it for the edit menu right now. And I'm gonna take a pause from these features, and I'm gonna look at some questions and answers people have, and then I will discuss what we once briefly touched on, depreciation. Okay. Okay, so first of all, if anyone successfully activated their software for 160 days that they give for the students, and if they did that, then they had some extra time that would like to help out those that have trouble logging in and activating the software, creating their user ID. They could be so kind and they'll post it on the Q&A. We'll put it on the whiteboard, and we'll be able to help those people that need to get it working for Monday's class. Regarding the exam, that's done by a third party, and more information will be forthcoming from Rabbi Wordy or Ms. Aronson from the office. Over Hanukkah, you'll get information about that. When I said you don't need softwares, you're not going to need the payroll. We're not working on payroll till after Hanukkah, but we're still going to have a class on. Again, don't confuse software from files. You have the Word software and you have documents. So I'm going to give you another QuickBooks file, a QBW file. Now that we know, I'm going to give you a QBW that you can use, but you still need a QuickBooks software to work and function. You might want to play with, learn over Hanukkah. So the software you have already, I'm going to send out an email with an attachment with the QBW. So Ms. Goldberg says she will help. If you please post either an email address or a phone number, and we'll put it on the whiteboard, and people will be able to contact you, and greatly appreciated. Maybe we'll give you 2-3 minutes, that you could, we'll enable your audio and you could direct people. I didn't do the full research on that. Again, accrual means that we theoretically earned it because we provided the service. We provided the service, and the customer owes us. So it's a realization method where if I did a service for $100, if I gave someone consulting for $100 an hour, I provided the service, I already earned it. And that's accrual. I already earned it. Or the same thing if I already had my cell phone bill and I used it for the month. In the case they bill you a month in early, but let's say you get your Con Edison bill and they read last month, you already used up the energy. Now you earned the bill, right? You already earned the expense. You accrued the expense. Cash means you actually paid it out. The cash left your bank, or you already have the money in your bank. And that's the difference in the cash accounting method and accrual. So it used to be that you had to go to customized report, and in the customized report, have to choose accrual or cash report basis. In the later versions, which was a nuisance, the later versions, they give you that toggle button right here at the top, report, cash, and accrual. You could bounce back and forth right away. And I'll tell you, so this is just selecting, when you print your report, you will know, and it's going to stamp. This is a time date now, 8:45. The date, you could have the feature, you could disable, you don't want the date printed on your report, but there's a reason why it's there. When you see your report, you should know, is this company on an accrual basis or a cash basis? And perhaps you're going to discover later on that the report is flawed because you're looking at an accrual basis, but the company does its a tax on an accounting basis. And maybe it's not even flawed. Maybe they have two accounting methods. When it comes to taxes, they want to know, they only want to pay what they actually collect in the bank. And maybe when they're applying for loans, they want to say, we bill a lot of business and we have accrual method. Well, it's beyond the scope of today, but it's something we have to be aware of. In an office, you have to ask your employer, how do you want the reports? Do you want a cash method or accrual method? Okay. Okay, so installing the QuickBooks is installing it, but now you have to activate it, right? So there's a way to activate it in the help drop-down menu. There's activate the software. And for that, Goldberg, I don't know if everyone sees the question, but I'm going to post, she gave the phone number, so I'm going to post it now on the whiteboard. You could take a moment, you can write it down. And she says she's willing and able to help people get through this challenge here. So let's take the phone number on the whiteboard. Oh, let's text box here. It is still here. Let's just share the whiteboard as is. Still have that message. Class will begin momentarily. But we have here a phone number, 917-804-6564. And thank you very much again for your time in advance, and success to everyone who's doing this. Okay, and the questions with P&L being off, we'll do that after 9:30, and we'll give time for Q&A, maybe 9:20. Let's take care of this question. Where do you download the software? Okay. Again, why would you open a new company with all the old info? Because you have a similar company, but a separate legal entity, and you want to have everything running the same thing. Let's say you're in real estate, and if every new property, you have a new LLC, and you want to have all the accounts exactly as the other one because you're doing the same transactions, but you don't want to have, but it's a different company. It has to be with, you want to have the same chart of accounts, but with no transactions. That's an example, and you could think of others. What else we have in the Q&A questions? Again, the number is for people who are still having trouble activating their student software for 160 days. So we have a student here, Susan Goldberg, who's offering her service, her time to help people get through that. Okay. If you recall, I had given you something called depreciation. What is depreciation? So we had discussed, we bought a copier. We have the asset here, $2,079. If you go into it, you'll see this is comprised. Let me stop the share now and go back to the QuickBooks here. We have here from Staples, we bought something for $379. We have a copy machine for $1,200 and an Amazon for $500. I guess that's a computer. Okay. So here's the thing. The copier, we estimate, will live for 5 years. right? So we can't say that when we spend $1,200, we have an expense copy machine. That doesn't work. That happens to $44 in the sushi that we ate up, and we made a bracha rishena, achrena, and shiyatza, whatever it is. So it's gone, and it's an expense. And we said electricity is an expense. The copier is not gone; it's here. On the other hand, in 5 years from now, the copy machines will be going to recycling, and then it will be gone. So are we going to say that we have in the end of 5 years, we're going to have an expense $1,200 copy machine when the money left at a bank 5 years ago? And why should we have to pay taxes on the $1,200? I mean, why is that expense deferred for 5 years? And the answer is it's not deferred. We recognize over a certain period of time the depreciation or the decrease in value of assets that expire. So with the exception of land, for example, which does not depreciate, even though the value might go down, but for tax purposes, it does not go down in value. It stays at the price you bought it. But if you bought a property that you're renting out, every year you can take a tax expense for the depreciation on your house. Obviously, when you sell it, so for example, you bought a house for $500,000, and just throwing an example, for 10 years, you're taking a $15,000 depreciation on it. So after 10 years, you depreciated 150. So the real value of the house is only 350,000 because you already took losses of 150,000. So when I go now and I'm going to sell the house for 600, I'm not making the $100,000 profit from my purchase price of 500 to 600. I'm really now making a profit of 250 because the house is worth only 350. I already took losses and I offset other income. So now I have to recapture that income, that loss when I sell it. That's the way it works by, for example, by a house. And by a copy machine, if we assume that it's going to live for 5 years, that would mean every year we're recognizing $240 of depreciation for the copy mirror. Now, what happens if I want to make a report on an accrual basis, not on a cash basis, of the value of the copy machine a month after I have it? So in this case, we don't do this on a calendar year. We do this on a asset year. So we bought this asset in November, right? 11/9, we bought this computer. So 5 years from now, 11 or the end of October, 10/31, 2025 is when we're going to write off the last $240 if we're doing reports annually, right? Even if we're doing our taxes on a calendar year of 12/31, but the asset is coming in at November. So we're going to take now in 2020 2 months of depreciation for 11 and 12. And the next 4 years, we're going to take 12 months for 21, 22, 23, 24. And we come to the fifth year of 2025. Actually, that's 2025 is the 24, 2025 is we only have 10 months of depreciation. So right now, we earned already the right to take a $20 expense at the end of November. How would we do that? Again, this is the journal entry. Company, I'm going to do this, and then I'm going to pause for those who want to catch up to do this journal entry because our income, our expenses will change based on this. So we have on not 12/12, I'm going to backdate it. And one of the ways to backdate is to do M minus, because M brings us to the beginning of the month, and minus brings us to one day back. Plus brings us forward one at a time. For every plus we press, we go forward a day. Every minus is one day. In this particular case, it would have been faster to just do minus minus because we're going back just 2 days. However, if you were holding the 25th of the month, it would be easier to just go M minus. And what are we going to do for our entry? And this is actually an adjusting entry, and I'll explain to you why in a moment. I'm going to put here depreciation expense, $20. Depreciation, it was already here. We never used it. Now we're using depreciation expense. And what am I depreciating? I'm going to put AC for accumulated depreciation, right? That means we're not saying the copier went down in value. And it's important to make this distinction with opposed to amortization, which we'll also discuss, right? So the depreciation expense is $20 because we have our copier for the month of November already. And accumulated depreciation is $20. And I will save and close. Okay, let's see the effect on a P&L. What we did now is a debit to the P&L, which is a expense account, depreciation. The credit is to the balance sheet, to the asset. The asset is going down in value. Now, I'm going to point out this difference between, if you look now on our P&L, profit and loss, you'll see now a new depreciation expense, $20 as of, see, I made my report this fiscal year to last month, 11/30. If I would just press minus on the report date to go to 11/29, depreciation expense disappears because we only put that expense on the books as of 11/30. So let me type H. I could have done plus, but I'll do H for the end of the month, and depreciation expense comes back. I'm taking a pause a second and give everyone a chance to do this entry again. Company, make general journal entries. And what we did was we did an adjusting entry to recognize depreciation expense of $20 and an accumulated depreciation of $20. That's the debit and the credit. I'm going to hold this window open so you can see it. You can save and close. We're going to come back to this in a moment. We said land does not depreciate. Land stays put. Doesn't move anywhere. Accumulated depreciation, I'm going to get to in a second. Right now, just make that entry, and I'll be able to explain it when you look at the balance sheet. Again, the regular depreciation expense means the expense we have for depreciation, which will be $20 per month. It'll be $240 per year, and that's why we are recognizing it right away. Accumulated depreciation is taking all that depreciation and adding it up. So at the end of this year, we will have $40 of depreciation expense, and that's it. Next year, we're going to start from zero again. So the end of next year, we will have $280 of depreciation. $40 from this year, $240 for next is $280. But the difference is, when you'll never see that $280 on a report of last year and this year. Last year's report is $40. Next year's report will be $240. If you happen to make a 2-year report, then we'll bring together, we'll merge the expenses of last year and of this year or next year rather, and you'll see that over the 2 years you had $280 of depreciation expense. But each year in itself, we said start 0 against 040, and you'll have 240. Now, what accumulated depreciation is, it's called a contra asset. We have here an asset called furniture and equipment, right? We know that in the furniture and equipment is the $1,200 copier. And you might have decided to break it down to track, well, here's general, but you might have had your computer here listed at $1,200 as an asset, your copier rather. The accumulated depreciation brings down the value of your assets, right? So you see, the asset is still the same, 2,079. If you go into it, it's not that your copier now is 1,180, right? No, it's still the same $1,200 because a copier is physically still here. So we keep on the books the full value of the copier. At the end of next year, we will still see copier $1,200, right? It's not going to go down to $280 cheaper. It's not going to be worth now $920. It's still going to be $1,200. What I will have by the end of next year is accumulated depreciation, which is the recognizing over time the decrease. So we have both things together. We have the physical copier, which is $1,200. We have the decrease in value, which adjusts for that. And now we have our net assets going down by $20. Originally, it was 206, let's say 143. And now it's 206, 123 because we lost $20 worth of assets. What happens is, at the end of 5 years, we're going to have 2,079 still sitting here. Why? Because the copier is still there for $1,200. But we're going to have accumulated depreciation also $1,200, right? So we're going to have accumulated depreciation $1,200 and an asset $1,200. Now, what's going to happen if the copier still lives? So the accumulated depreciation will never grow. You can't have more depreciation expense on the item. So if we have an S and the copier lives for 7 years, 2 years extra, we're not going to take an expense of $240 for years 6 and 7. Once we reach the value of the assets, we have a full $1,200 expense. Over the years, we have a full accumulated depreciation of $1,200, and it sits like that until we dump the asset. When we throw the asset out, then we're going to make a reverse debit and credit. We're going to credit the asset, right? Assets are debits. We're going to credit the asset for $1,279, for $1,200, and we will debit depreciation for $1,200. That's what happens by tangible assets. Again, tangible assets, you do a depreciation expense, and we do accumulated depreciation. That means we don't put on the books the asset going down. We just keep a contra asset, an amount which is going to be going against the asset. That's how tangible assets work, and it's called depreciation. Intangible assets, for example, like patents, or if you have closing costs, someone asked me about the closing costs of the summer home. So I put here actually summer home is 202. Really, it's summer home is $200,000, and the closing cost is $2,000, and that's called closing costs. And you can amortize. It's the same idea of depreciation. Over 15 years, for example, over 180 months, you are taking away the value of that asset. And so there we are actually going to put it against the intangible asset itself. It's going to go down in value. So the 200, if you take the, let's say $2,000 for argument's sake, and you divide it by 180 months, you will have about $11 a month, 23. You're going to have $11 a month amortization expense. So that as you take the expense, you will actually bring down the value of the closing costs every month. So it's going to go from 2,000 to 1180 to 1189. It's going to go into 1178. That's actually gonna go down in value and it disappears. When it's intangible, so that's the difference. When it's tangible and the physical item is here, since you see the item that costs $1,200, therefore we put a contra asset called accumulated depreciation. But when you have the closing costs, for example, which is intangible, because you don't see the $2,000 in cost, then when we take the amortization expense as a debit, the credit will be directly against the asset, not against a contra asset like accumulated depreciation. Now, many times these adjustments for depreciation are, or example, office supplies. I have to make a report. We know we bought office supplies for say it was $177 from that, and I go and take a look, and I see I still have $50 left. If I'm on an accrual basis, for example, not on cash basis, we want to make an adjustment. I didn't really have an expense of office supplies for $177. I still have $50 left. So we have to make an adjustment for about $127, recognizing that we still have that asset. Now, this is can be a tedious process, especially for larger companies, different assets, and they do it on an annual basis generally. But if you have to make a report, so you might have made this report like we did. We made this journal entry for $20. If I would come at the end of the year, 12/31, as an accountant, and make a $40 depreciation expense, I will have ended up taking $60 of depreciation in 2 months instead of only $40. Because here I come 11/30 and I made a $20 depreciation expense. For whatever reason, I had to make a report on 11/30 and I wanted to recognize what's going on. But then again, on 12/31, I'm going to make a calculation. When do we get the asset in November? I'm going to take 2 months of depreciation. So that's why there's a little arrow here called reverse, is that I can undo this entry for the following day. See, it's 11/30. It says the depreciation expense 20 and accumulated depreciation is $20. If I go reverse entry, right, it's going to come on 12/1 the next day, and it takes that entry number, which was 3, and puts an R for reverse. Depreciation expense reverse, the reversal. That means as of 12/1, we're setting the clock as if nothing happened. So let's see how this works. Okay. If I go back to my P&L, right? My P&L on 11/30, I have depreciation expense of $20. If I go 1 day further, depreciation expenses shows up because it was used, but it's 0. Why is it 0? Because if I double click on it, we'll see what happened. We had originally a $20 debit expense on 11/30, but 12/1, we undid that credit. And we undid that expense with a credit, rather. And then if I come at 12/31 and I make the $40 depreciation expense, that would leave me with the proper amount, right? Because now it's a 0. So if I make my report as a 12/31, I'll have the right amount of depreciation expense. Now, this might sound like $20 is a small amount, but let's say a large company, and thinking in terms of payroll, and the last payroll check was 12/17, 12/18 of the year. And we have 12, and we do payroll biweekly. So the next payroll will be, okay, rather if it was 12/18, payroll will be January 2nd. So the expense to the company on an accrual method is really 12/14 or 13/14 of a payroll is really from last year, and only 1 or 2 days is from the next year. The proper way to, and it could be a payroll is $100,000. The proper way to do accounting would be is to recognize that you have you will have to divide what your payroll is. Let's take a round number. Let's say your payroll is $14,000. It means you have a payroll every day in the biweekly payroll of $1,000 a day. You would recognize an expense of $12,000 or $13,000 for 2020, and there'll only be $1,000 or $2,000 expense for 2021. Now, what's going to happen? I'm going to come on, I'm going to recognize, how is it going to work? If I'm going to make a journal entry, a debit of $13,000 on December 31st. December 31st, $13,000 debit expense, payroll expense or wages. And then the money didn't go out. So I'm going to make the credit to payroll payable, right? It's like an accounts payable, payroll. I owe it. So it's a liability, right? The expense I'm taking on this year as a accrual method, $13,000. And I'm having a liability in the credit for $13,000. If next year I write out a check on January 2nd for $14,000, I'm going to be overstating my expenses because I recognize the $13,000 this year, $13,000 this year, and $14,000 next year. It's $27,000 of expenses in one period, which is why we would do the reverse entry. What happens? We recognize an expense of $13,000, right? And okay, actually, so we'll see if, and when we come on January 1st, there'll be a negative expense of $13,000, right? Not in this case here, it's zero because we're going through, let's say the amount was 20. We put the patient class 20 and we took it away 20. In this case, let's see how this goes in the payroll. We're gonna have, if we recognize a full expense of $13,000 this year, and payroll payroll expense, and we have a liability of $13,000. When we're gonna do the reverse entry, we're gonna have a negative expense of $13,000. And when I come on January 2nd and I write $14,000, it's gonna net out to a $1,000 expense, and it's gonna be a proper accounting. We'll try to go through this entry in actuality when we're doing payroll to see how it flows through. QuickBooks says someone has to do it to set depreciation schedule automatically, so every period will be entered on its own. QuickBooks says they have a method where they track fixed assets and they could evaluate it, but not always it could be done on automatic method because, for example, you tell QuickBooks to depreciate quarterly or biannual, semi-annually every 6 months, and you're gonna one day have to make a report 2 months in. You're gonna have to make a manual adjustment after 2 months to make a depreciation expense. Then QuickBooks will throw on top of it 1 month later the quarterly depreciation expense. So you have to always make this reverse entry, regardless after you make your original entry. And again, why are we undoing the expense? Because if I'm going to come at the end of December and take a 2-month depreciation on top of the 1 month I did at the end of November, I am double counting expenses, which is reducing my net income and therefore my taxable income. And that's another form of tax evasion. So we answered that question. And there are, so we finished inventory and syllabus. Is there other info we have to know? Terms, obviously there is, that will be forthcoming with the for payroll. We'll be learning about different taxes that are being withheld from paychecks. Some of you might be aware of it due to your current jobs, those of you who have yet, that will find out employers' responsibilities for employees, and employers pay taxes to match employees. We're going to discuss that in payroll in detail. Okay. Just a couple more minutes before we open up to questions and answers. We had in the syllabus, we had the terms there of depreciation expense. We discussed amortization. There's also something called prepaid expenses, which we will also be aware in the accrual method. So for example, let's say we have a car insurance and I paid 6 months of insurance. So if the year, everything will work perfectly, that the 6 months starts January 1st, finishes June 30th, and then we start July 1st again and ends in December 31st, every 6 months. So then we have our insurance expense for the car, and it's debit, insurance expense, credit, cash. That's very simple. Obviously, not everything is always simple. So you might have a fiscal year, they're overlapping. So what happens at the end of the year? If I come on November and I have an insurance expense of $1,000, that's going to take me for 6 months. So the 6 months are for December, January, February, March, April, May. So really, there's only 1 month this year and 5 months next year. Why am I taking the whole $1,000? Let's take a $900 expense, $150 per month, right? So if I'm on a cash basis, so I paid out of my bank the $1,000, the $900, and I'm only counting it once. So I'm not going to have that expense in the first 5 months of next year. I have it for this year. An accrual method, what really happened is you paid 1 month of expenses for this year of insurance, and you prepaid 5 months of insurance for next year. So you would have to make a different journal entry, which would really be, so let's say what you made the payment of $900 insurance, and right away you debited insurance expense, $900, and credited cash. What you would have to do at the end of the year is you have to make a credit against the expense, right? Expenses increase with the credit. Expenses increase with the debit. Now we have to decrease the expense. We have to undo $750. Why? Because 5 months is not for this year, it's for next year. So I'm going to credit $750 expense, and I'm going to put down an asset called prepaid expenses. And I have, or we can have prepaid insurance. Prepaid insurance, $750. And that's how it works this year on the report. But then I'll make a reversing entry, which will say, okay, I'm undoing it for next year. That means I wipe out the prepaid expense asset to zero as January 1st, and I throw back on the $750 expense to January 1st, so it will be in the proper period. That's again, so when do we do this entry? If we originally, when we wrote out the $900 to insurance, we took insurance expense, and then we have to undo the expense to make it an asset. Now, you might have done it the opposite way around. You might have done the $900 prepaid insurance, so you never had the expense. You debited your asset $900. For whatever reason, you wanted to show a higher profit at some point of the year, right? Let's say you might have a high insurance of not $900, $9,000. So you debited your asset, prepaid insurance, $9,000, and you credited your bank. At the end of the year, your asset doesn't exist anymore at $9,000. It's only $7,500 because you used up already $1,500. In that case, you will do the reverse. You will debit insurance expense $1,500, and you will credit your asset by $1,500. That is the basic idea of prepaid insurance expenses. If you originally recorded it as an expense, you have to make a debit to undue expense, or if you originally entered it as an asset, you have to credit the asset and the amount of the expense. We're going to open up now for Q&A. And there were some new technical terms we have here. Let's see, Laura P has a question.
Okay, yeah. I want to go back to a previous class about when you were saying about banking, about depositing things.
Yeah.
At what point do you deposit things in the bank, and how do you do it?
Everything should be deposited. Everyone knows.
Whenever you record that, let's say Mr. Gabay or whatever paid something, then you go to the bank and record it as well?
No. I said, let me rephrase. Whenever your company has money, you want to run to the bank and put it in. You don't know what's going to happen tomorrow. Maybe today there was money, and if you wait a week, the guy wrote out checks, it's going to bounce. Now, the way it works in QuickBooks, as I said, you don't put the money in the bank until you're putting it in the bank. It means you don't you could prepare your deposit in QuickBooks, make deposits, but you have to make sure that day you actually put it in the bank. Because the fact that the money is in your QuickBooks bank account doesn't mean it's in your real Chase bank account. So you made a mistake. You think your balance in your bank is 368, wonderful. But really it's negative 77 because you never put it in the bank. It's still sitting in your drawer.
Right, so that's what's happening. It's still negative 77. So
right. Yeah, so you have to go to make deposits. You go banking, drop down make deposit, put it in. Again, this is a technical exercise. This is a technical exercise what you're doing now. When you're running a business, you don't do this until it's really going.
So I went to banking and I went to make deposits.
Make deposits and come up with a window.
A window pops up that tells me payments to deposit. So I just okay.
You could check all of them besides for the $3 one, because that's the way I left it on the balance sheet.
I see. So you have to check them. That's what it is. Okay.
You could select all and then undo one if you whichever way you want to do it.
Right here. Okay, that's what you do. Okay, and then you press OK.
Yeah. I had done step by step. I actually deposited on the date. So if one was receipt 525, I deposited that. I put in the date 525. If one was 11/4, I selected that and I put in the date 11/4, etc.
Okay, so that's what it is. So whenever you get the money in, you have to right away deposit it, right?
Yeah, I would say faster bring it to the bank and record it in QuickBooks later than to record it in QuickBooks and then bring it to the bank. That's the point I'm making.
Okay, but I'm checking my balance sheet. It's still negative 77.
You have to refresh it up because when's your balance sheet report date? You just deposited now on 12/2. We deposited 11/3. So now go to the balance sheet, press T for today, and you'll see what your balance you're checking is.
Where do you press T for today?
You have on the top of the report, it says the dates as of when.
Right.
So press T as of, and it's going to be today's date.
12/02. Okay.
Yeah, and what's your new balance in your bank?
It's still showing negative 77 by Chase.
No, so you have to go. Did you actually press OK and deposit it? Look at your deposit date.
I did.
So you have to go into your bank. Maybe the date was wrong on the deposit date.
Okay, so again, I'm going back to make deposits. The date.
No, it's not gonna be there anymore. Now if it's in the bank, it's already there. So you have to go into banking, use register, and go into the bank, into the register, and see.
Yeah.
What's your last deposit, and you have to check the date.
The last deposit, 1 second, was 11/16. That doesn't make sense.
For what amount?
Right. Yeah, I don't know. That's what it tells me.
You try banking, make deposits. Well, how many deposits you have left?
Okay, on the Chase, I have,
No, no.
there's 203 in the balance, then there's negative 1297, and then there's negative 77. And the ending balance is negative 77.
No, again, banking, make deposits. I'm not sure you completed the deposit. Go banking, make deposits, see what comes up.
Okay, so it says the deposit total is 445.
You didn't deposit yet. You press OK.
Okay, so it tells me save and close or save and no.
Save and close. See,
Save and
you have a
close.
small one though. Blow it up. Okay, now you hear the beep. Now you'll see it.
Okay, but before it, I pressed the OK button. And
The OK only selected the checks that you were ready to deposit. Then it brings you to
okay.
the next one though, where it lines it
I
up and you
see.
can make memos. Now your bank
Oh,
is what?
okay. I have- Okay, so now it should be, yeah, I see already. So the Chase should be now 368?
Yeah.
Okay, fine.
Yeah, there was a place in the what's it called in the syllabus where we had written deposit 250 of your own to cover the bank at one point, but we didn't do that. So right now for this course, 368 is the right number.
Okay. Okay, thank you.
You're welcome. Okay, Shimon has a question.
Yes. Generally, how do you know when you have a copy machine, a computer? How do you know how long it's gonna exist?
Again, so there are two reasons why you're doing accounting for company purposes and for tax purposes. So the way it works is right now for tax purposes, it's called bonus. There's the bonus appreciation, which lets you and things that have a small lifespan of, let's say under 15 years, you could write it off for the first year. Like theoretically, it used to be if you bought an iPhone, for example, which is and it could have been $1,500, you would have to take the expense over 3 to 5 years. You can't, you bought your company bought 5 new iPhones. Wow, we could decrease our taxable income by $7,500 this year, and that you couldn't have done that. You have to break it over a couple of years. But under a ticket from Trump, he gave us 8 years. We're able to depreciate to write it off right away. Those types of equipments. That's from tax perspective. From company perspective, the question is when you're taking loans from a bank, do you want to show a higher profit or show a higher balance sheet, or you want to show a lower balance sheet and more expenses, right? So if you're going to push in to write off things faster, that means you have a smaller profit because you took more expense earlier and you have less assets. So you have to decide for what purpose you're doing your accounting.
And for taxes, why can't you take it off the first year at purchase, and the next few years you won't take it off?
Exactly. No, that's exactly. You can't take it out twice. You go.
So we could do it. We could do it once.
Everyone agrees. Yeah, everyone agrees that you can only. A lot of accounting is about the timing, and about taxes. It's also about timing, and the question is what type of loan you're giving to the government. So imagine you have. There was a whole thing about leasehold improvements. So you take a lease for a property for 15 years and you invest $100,000. Can you write off that $100,000 in year one, or you got to divide it over 15 years, right? So there was a glitch in the way they did the law. They're rushing it out, and originally you could have only done $100,000 over 15 years. And later on they changed it. They did it actually at the beginning of COVID. When they made one of the changes they pushed out with the whole stimulus package, is they changed that, and a lot of people were able to go back and amend their 2018 returns even to take back the full depreciation, and you could write off $100,000 of improvements in a property and wipe out $100,000 of income. That's amazing. But then again, the following year you don't get that expense a second time. You already took it.
Right. So back to, let's say, computer. How does the bookkeeper accountant know how much?
So the truth again. So this is the truth is you could wipe out the whole $1,200 in the first year for tax purposes. That's the truth. If you talk about a company, okay. So then there's There's accounting, what they call, it's called generally accepted accounting principles. It's called GAAP. So the way accounting is supposed to be done, realization methods, and you're supposed to. There's different. There are a number of acceptable methods of depreciation. I gave you only one example of depreciation, which is called straight line. You divide it over 5 years, so 1,200 is 240 per year, 20 per month. But you could have also decided to take 40% in year one, 40% in year two, and the next couple of years divide the rest. There are different ways how to do depreciation. I just took the simplest one.
Right, so who decides? The accountant has to decide on each item.
So you make an election. Yeah, you can. Sometimes you could change in the same asset in the middle of the time. You could change over and slow it down. So again, I don't want to get lost in the details.
Right.
But what's it called? Again, if you open up a new company and you got 20 new computers and desks and furniture, what's your objective right now? Are you trying to show a big loss in year number one, or you're really trying to get a loan, and maybe you took a hard money loan to get started, and you want to refinance and get a loan, and you want to show you have a profit. So look at all the assets we have. We have computers, we have desks and furniture, and it's value, and we made money this year. Once you get that loan, next year you're going to decide, okay, now I'm depreciating it, so I could, I don't want to have a profit. You have this, a lot of things. You need an accountant to make, strategic planning.
Mm-hmm. Now, when you put in the entry of the depreciation,
Yeah.
you didn't put in for what it is.
You could put in the memo copier. I'm just giving the idea, right?
I hear. Okay, thank you.
Not a problem. Moshe has a question.
Yeah, how do you activate the QuickBooks?
Okay, so we gave the number for Susan Goldberg. If it's still the whiteboard, we'll share it again. It's 917.
No, what's the email that you put in?
Again, I am not walking people through this process. So this is one of the people in this course. She did successfully. She's available to help people. Obviously, you're probably going to put your own email address because not everyone's using the same email address to get in.
Right.
Right.
Mm-hmm. Okay, and then the depreciation, we are doing that. You reverse?
Yeah, we did the reverse, of course.
Oh, we did do it. Okay, I wasn't sure if I should. If
Yeah,
I thought you were just showing how to do it. I wasn't sure.
And you actually do it, right?
Okay, thank you.
You're welcome. Let's see. Okay, Ms. Salman has a question.
Yeah, hi. Okay, when I came in, I was like a little confused. I came in like 2 minutes late. You were doing the software in the beginning, like in the edit section. When you were going through everything.
I was going through different menus. I was walking through different features of the software.
Okay, so then I contact the person you put on the thing to download the software, and that's different than the payroll software.
There's no software for payroll. I'm trying to explain. QuickBooks is like an application, like you have Microsoft Word, you have PowerPoint, you have Excel. QuickBooks is a software that you need to activate, and you're going to have it for 5 months. Okay. Separately, we're working on a file, an individual file called We Do It All. You could create 100 files, as many as you want. So I'm going to give you a company file that has payroll activated in it. It's going to be limited to that file. You can't create it's not your software, it's the file. It's the company. So you're not going to be able to make other companies with payroll. You're going to be able to work on this file that I give you.
Okay. Okay, fine. So basically I don't really have to turn anything on for that. It's going to be on.
No, I'm right. Well, there's 2 reasons. First of all, it costs money for payroll. The QuickBooks doesn't give it as a free feature. So for number one, I'm gonna, what's it called? It's going to work for a couple of weeks, so we could learn it. The other thing is, it's going to be even if it was free, it's a process of getting people to activate the software and then to activate payroll. So it's a whole thing. So I'm giving you a ready-made thing.
Okay, fine. Okay, thank you.
Yeah. Okay. Let's see who has any questions over here. Look at the Q&A first of all. Again, so the same question will be to Ms. Ringel. Please contact what's it called? I think it was Susan Goldberg with the phone number that's sitting here on the whiteboard. Same things for Moshe. People want how come I'm a malach? I guess how long I know payroll is going to work. It's going to work because as long as we're paying for that, that's how long it's going to work. Let's see here. Okay, Ms. Fleischer has no question. Hello? I see raised hand if you have a question. So we enabled the,
Hello, do you hear me?
yeah,
Yeah, okay. In the beginning, you were talking about file and new company from existing company. So if
right.
I would want to make a new company, I would go to, not we do it all, so I would go to new company and then start all over there.
Okay, new company will
What's the
take us.
difference between the two?
Okay, so new company is going to start a new company from scratch. You have to choose. Again, the basic idea of choosing a company is you're setting up either an LLC or a corporation. The equity accounts are different. That's number one. Depending on what type of company, if it's a corporation, if it's sole proprietorship, let's see if we go back here to new company. That's on the type of company. Then in the industry of the company, it's going to give you a chart of accounts. And we chose the industry of its general service, but then we went back and we started adding merchandising. So we were adjusting the chart of accounts. So new company from existing file is, I want to keep everything the same. I want to keep the same equity accounts. That means if you have what's called members equity, opening balance equity. If it's multiple partners, it'll be member one draw, member two draw, and equity. If it's a company, you have retained earnings. So that's number one. The second thing is my chart of accounts. We customized it. We added the HOA, we added MR, we added TLS. So if you want to have everything the same, you're going to use new company from existing account. If you want to customize it yourself, you do new company.
What was again
If you-
HOA? What was HOA again?
Homeowners Association fee. So again, new company, you're recreating the type of company, whether it's LLC, corporation, etc., which will affect the equity accounts, and the industry, which will change the chart of accounts. And
Then, so if you press new company from existing company, you're gonna see
then you're basically copying your file without the transactions. So you're gonna have the same chart of accounts. You're gonna have the same balance sheet accounts also.
but it's gonna say secondary company, right?
Oh, that's only if you have them both open. If you
Oh, I
call
see.
one, it's primary and secondary is when there's two open files. Otherwise, it doesn't say primary and secondary, it's just what it is.
Okay, thank you.
Yeah. Okay. Let's see what we're talking. Okay. If anyone still has questions, I see here. I think Olivia had a question earlier. So you put in the Q&A. Hello?
Hi. Hi, how are you?
Yeah, hi. Thank God, Baruch Hashem.
So yes, I have a discrepancy in my MR.
Yeah.
Um,
12 by $12. Probably didn't adjust the
it's off by $12 on the balance sheet, but
Yeah.
under merchandise, it's off by under
what's your average?
merchandise.
Your average is $1, not 75 cents. So the 48 that's left counts for a quarter.
So how do I fix that? Where do I go?
Okay, so I'm going to go on a limb here and assume that one of two things happened. Either you didn't change when you entered your Makaris firm, you didn't change it to 50 cents a piece. You left it at $1. Or the other thing that would have happened is that you didn't you adjusted your inventory from the beginning. You didn't put in the on hand properly in the beginning. So, like I said, everything has. If you're off at $12 on the asset, you're also off by $12 somewhere else because it's connected. So, let's look at your cost, the expenses, and let's go back. I have to get back to my company file. File, previous company, where we do it all. So you have your P&L open, you have your balance sheet open?
I have my balance sheet open.
Yeah. What is your, so
The MR is $24.
I understand that. Okay, could you check your, okay, double click on that, for example. Double click on your MR, and we'll
Okay.
see the history.
MR, first I have minus 75.50 under balance. Where am I reading? Where do you want me to read? From debits?
The MR should have had $100 debit and a $50 debit. Then a
I
130.
have that,
Then you have
150, and the total 150.
150. And the credits? You have
Uh,
126 credits?
No, I have $50.50.
Then the MR asset, right? Inventory asset?
Yes, no,
Yeah,
where?
you're not there, no.
Yeah, total inventory asset, $50.50.
You told me you offer $12. I have 36. So you offer $14?
The balance, I have $24.
Again, so if your debits are 150, that means your
My
credit
debit's 150 and my credit is
126.
$50.50. No, my credit is $50.50.
You want to tell me if your debits are 150 and your balance is 24, the difference is 126. Your credit's gonna be 126.
Well, my credit
What's
says 50, all my P&Ls
well,
are,
you start with the negative 75. Okay, so
yes.
where's it? You gotta press all. Go to your dates and all. See what happened there. What do you do?
Where should I press that?
The dates. You have the dates of the report. Go all, and you'll see your history.
I'm on custom.
Go
Okay, all, fine,
drop it
yeah,
down to
okay,
all.
all,
Start, what's the first entry?
okay, yes, you're right, 150, 126, 24, I got that.
Right. So where's you want? But no, but you start off with a negative 75. So
Yes,
what's your one on your debt credits? What do you have? 120.
total I have 126.
Right. What's
Before
the
that,
break?
I have
What's the breakdown?
75.50, $50, and sales receipt 50 cents.
No, something's really off here. This is what's supposed to be. You have an invoice of 113.25, and that took double click that 113.25.
I don't have 113.25. I can't see your chart. If you,
Oh, I'm sorry. I have to share it. Are you able to see the Zoom and your computer at the same time?
I'm using a laptop and I'm using
Okay,
an
fine.
iPad.
Very good. Okay, so but you do have a customer. You sold to Gabay, you sold to Glick. Those are only two sales for MR.
I have, 1 second, please.
You see here on the name?
Yeah, I have Machon Yerush. I have Gabay Rabbi credit 75.50.
Double click on that first. What are you selling for? What are you selling for $75?
I have quantity 151 MR Megillat Root.
Yeah. What's the price?
The balance due 339.75.
What's the price for each?
225.
Okay, so the invoice you have properly. Well, so what was not set up is what the asset is. And it's crediting too much. So you have to go back to Your lists, item list. See what happens.
Back-
See, go to the item.
List, item list, okay.
Yeah. And you have the inventory. How, okay, you have the right about the inventory, right? You have 48 pieces.
Yes, I have
Whatever,
48, 45, yes.
Good. Double click on the 48. What was your average cost per piece?
Um, Sales price, average
the
cost
bottom.
50 cents, 50 cents.
The average is not 50 cents, the average is 75 cents. So because you're 50 cents less, like I said, you quarter less, 48 pieces. So that quarter translates into $12 less over 48.
Okay, so how do I fix that?
So let's see what happens. Go to vendors, inventory activities,
Vendors, inventory activities.
and adjust quantity value on hand. Let's go back to previous. See what happened. What did you do on the first time on the 525, which is the opening
I
balance?
have 45 quantity on hand.
Go reverse. Not. We went to reference again. We went to vendors. We went to inventory activities. Adjust quantity value on hand, and we have to make a reverse to previous, where it's want to see what
Again,
happened.
vendors, inventory activities, adjust quantity value on hand.
Then there's
Okay.
the previous is the sandwich in between the menu bar and
It says you must specify an account for this adjustment.
we're not making an adjustment. Okay, vendor inventory. What happened when you went to adjust quantity in hand? It said you must send.
Uh, Vendors,
Yeah, oh yeah, it shows it adjustment account. We're going back. We're going to previous. We're going to see what happened before. You see
no,
where
no,
it
it
says,
still says you must specify an account.
okay, close the window. Go back, try it again.
Okay.
Vendor inventory activities
Vendor, inventory activities, adjust
Adju-
quantity value.
on hand. Yes.
Okay.
What happens?
That-
Or it already gives you this error. You must choose an account.
No, now
Okay.
I don't have anything. It
Okay.
doesn't say any
Okay.
item, no
Okay.
description.
Good. So the second, right under the menu bar is called
Yes, I
previous.
see previous. Click on
Click
previous.
previous.
Okay,
You see
fine.
the opening
says-
balance equity. What happened? Do you see opening balance equity?
Okay, I see TLS, quantity 30, 60.
30 and 60. So this went in properly. What didn't go in properly? So when you repurchase, you probably put them both in at 50 cents. So that's what we're gonna troubleshoot. Go back to your
Okay.
vendors.
Vendors.
Let's see here. I probably could have done it from there also, but I'm just walking to see. I wanna go to your bill from Machane Yerushalayim. What's your bill?
1 second. Machane Yerushalayim, yeah.
Yeah. What happened there?
1 second.
Machane Yerushalayim right
It's
here. You have your
minus
bill.
100. Yeah, a minus 100.
Okay, so double click on it.
Okay.
And it's going to say what? What's the bill for it? What's the item? MR? $100
100 at $1, also 100. I have all that.
Yeah. What's the date of your when you received it? 5/25?
525.
Good. Close that. Let's go over to Makar's Farm. What's the bills you have from Makar's Farm?
1 second. 2 account payables, minus 100, minus 50. Yeah, just like you.
Account pay. Yeah, so open the 100.
But what is an item receipt? One I did bill.
You never converted it to a bill. So you have 100 items, but for $100. So the average,
The $100 is a bill and the 50 says item receipt.
right. So what your inventory took in 200 pieces. You never got the cost of $100 in, so it cost you 50 cents each.
What do I do?
So you have to vendors enter bill for received items.
Okay, vendor. Okay.
Enter bill for received items, and you're going to choose the vendor, Makar's Farm.
Okay.
And you're gonna see it's a highlight of one line over there for one
Yeah.
bill. You click on it, you press OK.
Okay, and now I have a bill that says $50.
Yeah,
and then
but
save and
before you
close.
no, wait, make sure the date is 5/25, not
Okay, let
11.
me do that.
Because basically what's gonna happen is you're gonna create yourself a bill dated today. So for
Right,
$100,
it won't pick up.
it's not gonna pick up that from then when you made the sale. It's an average of 75 cents.
Okay, and then save and close.
Yeah. Now, what's your balance sheet assets worth today?
Let's see. Two. It
M-
still says MR 24.
Okay, first, okay, refresh it. The refresh button on the second line.
I'm sorry, say again. Refresh, yes, over there.
Yeah.
Okay.
Yeah. It still says 24?
Yeah.
Okay, we're gonna have to make it, so we might have to make over. Well, this is the reason why, let's see, give me a second here.
Should I just make sure the date was, I think, yeah, it should have been correct.
Go back a second to your item list and so what's your average, your average cost?
My item list for which one? MR?
Yeah,
50 cents.
it's still stuck at 50 cents, right? Okay, what I would suggest is change the sale from, because everything goes in order. So theoretically, you had 200, when you made that sale, you had 200 for $100. You made a sale, it's 50 cents each. And then afterwards, even though it's the same day, it's still registering as when you bought it. So you have to go back to Gabai's invoice and make it one day later.
Gabai's invoice? Okay,
Gabai.
so what do I do? A list?
So no,
Item list?
customer center,
Customer center?
Gabai.
Gabai Rabbi, okay.
Yeah, and change, if he's 525, change him to 526. Which one? The invoice of 339.
Oh, I think I see it. I put in 2019 by accident instead of 20. Is that going to be the reason I have all these mistakes?
When you sold it to Gabai?
Yeah.
Yeah. That's why you had a negative. You're never supposed to even have a negative.
Okay, one
You
second.
pre-sold it at the price, but you also pre-sold it at 50 cents because that's the way the computer registered when you got it the first time. So the only one it pulls up is, so just change the date to 2020, and then we'll see what.
Okay.
But you still might have to change the date to 1 day plus. That's what I'm trying to.
Okay, so I have it so wait, put it to 528.
No, leave it at 525 because I'm curious to see, now we're doing this way, what happens if we do 525 now?
Okay, 0.
What's your average cost now?
1 second. It still said the date 2019, even though I edited it.
Double
Hold
click
on.
double click on it and change the end to 2020 and.
Because I changed the ship to. My average cost is still 75 cents. You want me to
That's
look at?
still, no, that's still, it went up. Before it was 50 cents. Now
Okay,
it's,
yes.
it's very good. Now
Okay,
it's-
good.
now it
So
should
wait,
be-
let me go
now
to
it
the
should be- now-
reports.
now it should be fine.
Okay, now the MR is 36. Yes, thank
Yeah.
you so much.
Okay.
I'm sorry.
No problem. So QuickBooks is like a machine. The way you program it, that's the way it works.
Okay, got it.
Yeah.
Thank you.
Yeah. Okay. One last question for the night, and we'll be finishing by 10 o'clock. Hello?
Yeah, so the balance sheet, you're supposed to, what are you supposed to be at by the date? This fiscal year or this fiscal year to date, or like what's,
You can make the report however you want it. It's endless and you can customize it.
yeah, but then we're gonna have different amounts.
No, I gave the amount as of 11:30.
One
As of
second,
11
so what are we supposed to be
So
at?
the difference,
year?
the difference between the email I sent out yesterday and the email I sent, the way it would be today is that we added a $20 cumulative depreciation and a $20 expense. That's why I wrote, as the class was taught until now, this will be the P&L and the balance sheet. But if we're going to go back, for example, when I do payroll and I'm going to put in entries for May, it's going to change again.
Right, no, but my question is, what's the difference between this fiscal year to date, or
This fiscal year is the whole year through December 31st.
so
Today,
in other words, from
today,
January 1st to December 30?
right. If it's this
Okay.
fiscal year to date, it's till today, which is December 2nd. Then if this fiscal year to last month, because people want to have full months, not partial months. And then you can have quarters, and you can have, that's why you have all that. They give you a bunch of options, and you can customize yourself what you want.
Mhm. Okay, thank you.
All right. Thank you for joining, and Mr. Shem, we'll see you on Monday.